Last year alone, I reviewed the retirement plans for about 369 Canadian families. Some of those folks were on track, they just need a little bit of fine-tuning. Others were making massive unintentional mistakes that could derail their entire retirements. Now, I'm not here to throw shade. Most of these folks didn't even realize that they were making these missteps. But that's the thing about blind spots. You just don't know what you don't know. So today, I'm going to share the 7 biggest mistakes I saw last year straight from my naughty list. I keep it right here on my desk, actually. These aren't just like theoretical errors. They were real life examples of what can go wrong. Again, my goal isn't to scare you, but just to shine a light on some of these unforced errors so you can avoid them and hopefully retire with confidence. Let's dive in. But first, hey, if we haven't ever met, I'm Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. As a family-owned firm, we've been helping folks retire for about 35 years now. But last year, we really had a chance to hear from just a ton of you. Folks out kind of in the wild, working towards retirement with real life questions or problems. Even the smartest, most successful people I met with had gaps in their plans. My job, our job over here is just to shine a light on some of those gaps so that you can fix them. So let's dive into the first mistake. And trust me, it's a big one. One of the most common and dangerous mistakes that I came across last year had to do with concentration risk. So this one client I met with had about 85% of their entire portfolio tied up in a single stock. Now, I won't name the stock, but I'll say it just wasn't their company stock, which is a more common scenario, but just a single public security that they'd been holding for a few years. They'd ridden this stock up to the highs, but by the time that we had sat down, the stock had dropped by about 54%. His retirement was firmly at risk by this point. And he was then reaching out for a conversation about what he should do. Now, here's the thing about concentration risk. It just feels so good when it works. But when the tide turns, it can absolutely devastate your financial future. Now, for this person, the question became, what do I do now? Selling at a massive loss wasn't appealing, but holding on could potentially mean further downside. Now, when it comes to diversification, that can mean a ton of different things. This is individual security diversification, but you also have asset class diversification, you have sector diversification, you have geographic diversification, and all of it can seem like everyone's just being super safe. But diversification isn't just a buzzword, it's a lifeline. A well-diversified portfolio is going to spread your risk across all of those sectors, those geographies, those asset classes. Especially as you start getting serious about your retirement, you have to come to the realization that while concentration can be a great way to grow wealth, the only way to preserve it is with diversification. So if you're holding a large position in one investment or even a handful, you should ask yourself, could I sleep at night if this dropped by 50%? If the answer is no, it's time to rethink your strategy. Now, the second mistake on my list from last year involves one of the most powerful tools Canadians have for retirement planning, and that's the tax-free savings account. So I worked with a family who had done a pretty bang-up job of maxing out their TFSAs every year. They were business owners with about $6 million in their corporation. They had large RRSPs as well. On paper, right, they're in great shape. But here's where things went sideways. One year, they decided to reduce their salary and their dividends that they were taking out of their company. They decided to instead live off of their TFSAs. Now, I have no idea where their investment advisor was at this time. I have no idea where their accountant was at this time. I frankly don't really know how this passed anyone's sniff tests or how it could have come out of the mouth of their accountant. Maybe it did, maybe it didn't. On the surface, it seemed harmless, maybe even smart, right? It essentially created a temporary tax valley for that year, and that felt great for them. But what they didn't realize was the long-term cost of this move. Let's put this into perspective. $50,000 withdrawn from a TFSA today could have grown to be worth $200,000 tax-free over 25 years into the future. That is a massive opportunity cost. But the bigger problem for them was that they now probably should reinstate that value back into their TFSAs. And that's going to require them to pull even more income from their corporation in future years, drawing even more than they need to fund their lifestyle. in order to get those dollars back into their TFSA account. So that tax savings that they generated in that single year, it's likely now going to be lost as they try to rebuild that balance. Now, the TFSA is a great long-term compounding machine. It is not a piggy bank, despite how the big banks tend to market these accounts. And while it's tempting to tap onto it for kind of short-term flexibility, you really got to weigh that against the future growth that you're giving up. So the takeaway here, use your TFSA strategically. If you're a business owner, work with your planner to structure your income as efficiently as possible without undermining your long-term wealth building potential that comes from that account. Now, the third mistake, and is one that I see far too often, especially among Canadians who've done a great job building their wealth on their own with their own investing. This one involves old age security, or OAS, and how a portfolio full of Canadian dividend-paying blue chip stocks can unintentionally sabotage your retirement income. So here's the story. I met with this couple. They were on the verge of retirement. They had a large non-registered investment portfolio. It was packed with those classic Canadian dividend stocks, right? Bank, utilities, telecom companies, all of our Canadian oligarchs. These investments had served them well over the years, and it provided them a steady amount of income, a little bit of growth. It was self-managed. But as we dove into their financial plan, a really glaring issue emerged. And because of the dividend gross-up rules here in Canada, the income that was reported on their tax return was much higher than the actual cash flow they were receiving. So this inflated their income, and it was enough to push them well over the OAS clawback threshold. Essentially, they were set to lose most, if not all, of their OAS benefits during retirement. This was a $17,000 per year issue. And here's the kicker. OAS isn't just a nice to have. It is a guaranteed, inflation-adjusted income stream for life. And while I agree it's not worth kind of moving heaven and earth around to optimize for receiving it, losing it because of an inefficient investment strategy is like leaving free money on the table. So the solution, again, would be to diversify the portfolio. While Canadian dividend stocks certainly have their place, relying too heavily on them in a non-registered portfolio specifically can create unnecessary tax inefficiencies. A more balanced approach, right? Something that's going to incorporate global equities, a total return strategy, other asset classes, all of that can help preserve your OAS benefits while still achieving your investment goals. The lesson here, right? What worked in your accumulation years may not actually work in retirement. Tax efficiency becomes just as important as investment returns when planning your income streams for retirement. And the fourth mistake is a classic example of you just don't know what you don't know. It involves a couple who decided to file their taxes on their own to save a little bit of money, but the errors that they made ended up costing them far more than they saved. So here's what happened. This couple had a fairly straightforward situation. A modest retirement portfolio, had some joint non-registered investment accounts that came from a recent inheritance. But they made several small mistakes that added up to big consequences. So first, they reported all of their investment income from this joint investment account on one spouse's tax return instead of splitting it between the two as they had historically done on their tax returns. Then they claimed the deductible investment management fees on the other spouse's return. This mismatch will have raised a red flag, no doubt, within the CRA, and it puts them at the risk of an audit. Then they completely overlooked the pension income splitting opportunity that existed for them, which is one of the simplest and most effective ways for retirees to save on tax. By not splitting the pension income, they ended up paying significantly more in taxes than they needed to. So the result of all this was thousands of dollars of unnecessary taxes and the stress of potentially being audited. All of it needed to be corrected. So the fix here is simple. Just when in doubt, hire a professional. This is not universal advice here. Some folks certainly can do this on their own, but don't let kind of DIY pride cost you money. A good accountant, a good tax preparation professional can help kind of pay for themselves many times over just by helping you avoid these types of costly mistakes. Now, this next mistake comes straight from the world of entrepreneurs, and it's a big one, and not preparing your business for sale well in advance. So we worked with a business owner family who had built a successful company over a few decades. And when the time finally came for them to sell, they assumed that the process would be relatively straightforward. They had even already found the buyer. They had done the hard part. But it turns out they missed ensuring that the business was structured properly to maximize the sale value. And that just takes time. So in this case, the business wasn't purified for a share sale, which means that it didn't meet the criteria needed for the lifetime capital gains exemption to qualify. This exemption can save Canadian business owners hundreds of thousands of dollars in taxes, but only if the business will qualify. So the sale negotiation, ultimately because of this, became a nightmare. Their team of advisors was rather reactive instead of being proactive. They were constantly scrambling to fix issues as they arose. This created delays, it added stress, it even put the entire deal at risk at one point. Now, the solution here, if you're a business owner thinking about selling, you need to start planning at least 2 years in advance. You got to work as well with an experienced team of professionals, ones that aren't going to just react to things as they come up, but will lead you through that process proactively to ensure your business is structured optimally for sale. This includes purifying the business, right? Addressing any operational inefficiencies, making sure that the financials are all clean and transparent. And the takeaway again, selling a business is going to be one of the most significant financial events of your life. Don't leave it to chance. A little bit of foresight and the right team here can make a difference between a smooth and profitable sale and a stressful, costly ordeal. Now, next, this one is going to be about how being overly cautious with your money can actually erode your wealth over time. Let me tell you about this client. They were a highly educated business owner. They had recently sold their technology-related business. They had parked the proceeds into a GIC. And that sounds probably pretty safe, right? Especially at a time when interest rates were paying higher yields than any time in the last 15 years. But here's the problem. Their $5 million in GICs earned about $500,000 over 2 years in those high rates. Meanwhile, global public equities in the same time frame grew by about $2 million. That's a $1.5 million gap, a gap that they didn't even really realize existed in that magnitude. To them, their conservative approach, it felt prudent. They just didn't consider the opportunity cost of not investing in a more diversified, growth-oriented portfolio. The cash felt comfy, it felt cozy, it felt familiar, and they stuck in that allocation longer than they actually probably intended to. So the issue wasn't just about missing the higher returns, it was all about inflation and the long-term erosion of their purchasing power. Again, remember, this was in a high inflation environment. The GICs, they might feel safe, but they didn't protect them from the slow burn of rising costs over time. The irony here is that this safety was sought by a former business owner, right? Someone who understands investment theory, capitalism, right? How businesses work, but they really fundamentally struggled to trust the public markets, which is really just a collection of some of the biggest businesses run by some of the brightest and most incentivized minds in the world, right? It's the same thing, but in their mind, they were different. And being unwilling to kind of improve financial literacy in this area came at about a $1.5 million cost. So playing it safe isn't always as safe as it seems. If you're too conservative, you might end up robbing your future self of financial security and options. So one last big mistake before we wrap up, and this one has to do with leverage. So this couple came to us with a pretty ambitious plan. Their entire retirement strategy was going to be built around leveraging real estate, right? So buying properties, improving them a little bit, borrowing against the equity, and then repeating that cycle. On paper, it looked like a pretty clear shortcut to wealth, right? You know, their online forums, the courses that they had purchased certainly seemed to paint that picture. But again, in reality, this produced massive and unnecessary risk into their lives. So here's the problem. Their plan depended on absolutely everything going perfectly. Property values needed to keep rising. Interest rates needed to keep normalizing. Their health, their ability to manage kind of multiple properties, it couldn't falter. Rents needed to keep on stepping up. If one hiccup happened in the economy or in their personal circumstances, the entire strategy could crumble, hinging on a near 100% loan-to-value ratio. And when we ran the numbers, we found that a much simpler approach, one that didn't involve so much leverage, so much stress, could actually achieve nearly the same results without the sky-high risks. So what can you learn from this? Well, number one, don't over-leverage. real estate can be a great asset, but leveraging it to the hilt leaves you vulnerable to market downturns, rising interest rates, or unexpected personal challenges. Number 2, you got to stress test your plan. You got to always ask, what happens if things don't go according to plan? If you need everything to work out correctly to make the deal work, that is not the right deal for you. A robust retirement strategy should be able to weather economic storms, personal setbacks without derailing your future. And third, sometimes just consider simpler alternatives, right? Sometimes the best plan isn't the most complicated one. For this couple, kind of a diversified portfolio combined with some smaller, more manageable real estate positions could achieve their goals with less risk and certainly more peace of mind. So lesson here, just don't let the allure of high risk strategies blind you from their potential downsides, especially as you approach the final years before your retirement. Retirement is about creating stability. It's about creating freedom, not living on the edge of your seat. A balanced, kind of more thoughtful approach can help you retire with confidence and without all the worry. Now, I've been saving these mistakes on the side of my desk for this exact video for a year now. Mistakes like these, they're often more common than you think. They're often made by people who feel like they're doing everything right. Often, frankly, just smart people, period. Now, the good news is that these mistakes are absolutely avoidable. You just need the right planning, the right advice. If you've been wondering whether you might have a blind spot in your own retirement plan, don't wait until it's too late. Take time to review, adjust, optimize so that you can retire confidently and avoid being on my naughty list next year. Now let me know in the comments which of these mistakes maybe surprised you the most, or if you've seen others that I should add to my list next year. Otherwise, that's all for now. Thanks for watching. I'll see you in the next video.